Welcome to Legal Lines. My name is Tom O'Shea. This program is brought to you by the York County Bar Foundation. My guest today is attorney Timothy Bupp from CGA Law Firm. Welcome, Tim.
Tom, it's been a few years, but it's wonderful to be back with you.
Thank you. And we are going to be talking about taxes, federal income taxes to be exact. We're talking about the way the new tax law that went into effect in 2018 will impact most people.
If you find taxes interesting, and who doesn't, there's certainly a lot new to talk about this year.
I know that, and that's why we have you here, because Tim has his LLM in tax law. What's an LLM?
It's an awful lot of classwork and an awful lot of driving back and forth to Temple.
It's an advanced law degree, by the way.
I'm glad it's behind me. So.
Okay. But Tim has his LLM in tax law, and we're going to be talking about the Tax Cut and Jobs Act.
TCJA, some call it the Trump Tax Act. This year, 2018, is the first year it's going to be into effect, and it's really going to make some dramatic changes, Tom.
It impacts a lot of people. Just about everybody who files the federal income tax will be impacted some way.
Everybody, that's true.
Okay, well, let's talk about some of the big changes on it. To begin with, the law deals with the corporate taxes as well as the individual taxes. I want to focus very little on the corporate taxes. We're going to focus mainly on the individual taxes, but briefly, how does it change corporate taxes?
Well, that's good because we don't have enough time to talk about everything that it does. But the Tax Act's purpose, I think its true purpose from Congress was to make changes to the corporate tax rate. And the changes that it made were dramatic. Dropped the corporate tax rate from 35% to 21%. That's a big difference for corporations. And you saw the results of that all through this past year. Earnings for corporations are up because they're paying less tax. There were also dramatic changes made to the estate tax, the death tax, the federal estate tax. For years, the exemption amount for that has been increasing a little bit every year. From back when I was a young attorney, it was $300,000. After $300,000, you had to start paying tax.
It was $175,000 when I was in law school.
Tom, you make me feel young, right?
$175,000.
Sure. It crept all the way up to $5 million. Well, it doubled now. Now it's more than $11 million per person. So a married couple with $22 million won't pay any of that tax at all.
I know that when you hear politicians running for office, they talk about the death tax as though it's going to impact everybody. But what you're telling us, it really only impacts people who have more than $22 million in their estate.
Not just the upper 10%, not just the 1%, Tom, not just the 1/10 of 1%, but the 200th of a percent of the population have to worry about that tax. So it's really pretty much out of the picture.
Okay. All right. So that does not impact our average listener.
Most people are going to be focused on the individual income tax changes, and they are dramatic.
And what's the most dramatic part of it?
Well, it's probably the brackets, right?
Okay.
All of the brackets have changed. Part of what was promised with the Tax Act was it was going to be simpler. We were going to file a tax return on a postcard sometimes, right? Maybe there would only be 1 or 2 brackets. Well, none of that happened. There are still 7 brackets, just like there were before. But the tax rates in almost every bracket are lower, and the range of the brackets are broader. So more people are going to pay less tax for their income than they've paid before.
All right, let's tax brackets for people who don't speak this language. Basically, is the more income you make, the higher you're taxed.
Right.
Okay, so if you're in the let's say the 25% tax bracket, that doesn't mean all of your income is taxed at 25%.
That's correct.
So much of it is taxed at 0. Then so much is taxed at like 10%.
10%, 15, 22, and it goes on
so
up.
only the upper part of your income gets into the higher tax bracket.
Right.
So what the new tax brackets are is, as I understand it, they're lower.
That's
the
correct.
highest tax bracket used to be 39.6%, I believe.
That's correct.
Now what is it?
I think that's down to 34%.
And it used to be that 39.6 for a married couple came in somewhere around $450,000 or so.
It's much higher than that now. The brackets
It's now it's
yeah.
the 35% is you have to own
Right.
over like 700 or something.
Sure, but most of
some
the
large
brackets,
amount of money.
most of the brackets that people are doing with are like the 22%
Right.
bracket, those lower brackets, and those brackets are broader and they're lower than they were before.
So somebody who would have been in let's say they're in the 10% tax bracket, okay? They can have a higher income and still remain in the 10% tax bracket now.
That's correct.
Okay? And then the next bracket doesn't jump up as great as it used to.
That's great.
Okay? So for the most part, that would mean most people are paying less in federal income taxes.
That's true on that level, right? From the start, the tax, the amount
Purely
of
on
tax
the
that you
tax
pay
brackets.
on the brackets. But the devil's in the details, and there are a lot of details
There's
that
a lot
go
of
into
details,
that.
I know that. But the biggest part of it is, as I understand it, because of the way the tax brackets are structured, and because they're now lower, and because they are graduated, the higher your income, the bigger the tax break is for you.
So you make a very good point. In general, that's the way it worked.
So somebody who makes like $50,000 might save from the prior tax law, if it's just purely on the brackets, they might save like $2,000 a year.
So yeah, consider somebody that makes $100,000. If they were in the 28% tax bracket before, which they probably were, or the 25% tax bracket, and now they're in the 22% tax bracket, well, they saved $3,000 right there, just because of the brackets. And a lot of people are feeling that already, and they don't even know it, Tom.
Because back in January, after the law went into effect, the withholding law was changed.
Exactly. They've changed the withholding to match the anticipation of how much I'm going to receive. So they're, because in the brackets I'll pay less tax next year when I file my taxes, they're already withholding less from me in every paycheck. So that feels good now. It's going to be interesting to see if when I file my taxes, if I still get a refund like I've gotten before, or if that refund has been entirely eaten up by the smaller withholding. My accountant assures me that's not going to be the case, and that I'll still get some kind of refund, but we'll see how. It's interesting because there's so much of this that we're not really going to know until people file their taxes. It's going to be winners and losers.
And you said the devil's in the details, so we're going to talk about some of the details that impact the average person.
What do you want to know?
Okay, well, the first one is the standard deduction. What is a standard deduction?
Well, all of us, right, who file taxes always got a break right off at the start. Standard deduction for a married couple. I'm married, so that's usually what I turn to first. That was always $12,000. First $12,000 wasn't taxed, right? That was an exemption amount. Now that's been doubled. $24,000 is the new standard deduction that we all have. Right?
So the standard deduction, as I understand it, is people get to deduct certain things. They get to deduct like their mortgage interest, which is a big one. That still exists. But if you don't reach a certain number for deductions, just by filing a tax return, you automatically used to get $12,000 to deduct, and now that's $24,000.
Your point is well made. You used to be able to choose between the $12,000 standard deduction, or if you could show deductions that indicated $18,000 of deductible expenses, you could take that instead.
So when we're talking about the deductions that the average person would normally make under the prior law,
Right.
it would have been their mortgage interest.
Sure.
It would have been their state and local income taxes.
State tax, local tax.
Their real estate taxes.
Right.
And charitable contributions.
Charitable contributions, other.
There were a few others for high medical expenses.
Right.
Okay, and some miscellaneous expenses that people could deduct.
Yes.
They would itemize.
There were a whole array of deductions, and a lot of time was spent right around this time of the year and focusing on pulling your receipts together and making sure that you've got a full array of deductions that you can share with your accountant so that he can maximize your tax savings.
Okay, so you'd be pulling out receipts that showed you gave to this charity, you give money to your church, or whatever it might be, and they would add it up to see whether or not you would go over $12,000. And if you did, you wouldn't take the standard deduction. Instead, you would deduct all of what you paid that was deductible.
Tom, you know this stuff as good as I do.
Okay.
Now we've got a whole new world.
But now it's 24,000.
24,000.
So
right?
the average person might not reach $24,000 worth of deductions.
Well, it's certainly going to be a lot harder to come up with $25,000 worth of deductions. And those who have studied this estimate that the amount of people who itemize successfully is going to decrease from more than 35 million last year to maybe less than 15 million this year. It's going to be harder to successfully pull enough deductions together to get you over the exemption amount.
Does
So-
the law take away any prior deductions that the average person would have had?
Well, I'm sorry to tell you that that is the case.
And what are they?
The devil's in the details. There's a lot of changes. A lot of things that we used to take for granted as far as deductions are no longer allowed. And one of the most important ones is the SALT tax. You know what the SALT tax is, Tom?
State and local income tax?
Very good, right? The taxes we pay.
Well, state and local taxes, not just income taxes, state and local taxes.
State,
SALT.
State and local tax, you got it. The taxes we pay on to the state, to our municipality on our income, our real estate taxes, both local and state for our houses, are all SALT taxes, and they were all fully deductible before, but now they are capped. They are capped per filer at $10,000.
Now, when this was put into place, there was a lot of discussion about how this is not fair for people who live in certain states.
There are certainly winners and losers when it
Is
comes to this
Pennsylvania
deduction.
a loser state
I would have to say that we are.
on the SALT?
We're a high SALT tax, a lot of state and local tax here. In the Northeast, a lot of our neighboring states, New Jersey and New York, are in the same boat as us.
Okay.
So-
Because we have a relatively high state and local income tax.
Right.
Roughly 3% is the state tax. It's 3.07, I believe.
You're correct.
And the local tax is 1%.
Right.
And what we also have that's relatively high is our real estate taxes.
There's no question about it. We have one of the higher real estate taxes in the nation.
So if somebody has state and local income taxes plus is paying real estate taxes, chances are they will pay more in taxes than that $10,000.
It's certainly going to be a problem for most filers.
Okay.
For example, if my real estate taxes on my house or on my little farm are $10,000, right? I can deduct that, but that's it.
You can't deduct the income taxes you pay to the state or the local government.
All of that is gone, and so I'm paying tax on the money that I'm paying in tax.
So the federal government's taxing you on money that the state's tax has already taken out as tax.
Doesn't that sound attractive? Right.
And that's been around for many, many years, that your state and local taxes were fully deductible for federal income tax
That has
purposes.
been a deduction. That's been a standard principle of taxes and deductions for decades.
Not to double tax.
Yeah.
So that limits you to only $10,000 that you can now itemize on that list. The mortgage interest, though, remain the same.
Mortgage interest still remains fully deductible. However, it's capped at a mortgage amount of $750,000.
Okay.
Mortgages that are higher than that, there are limitations on how much you can deduct. By and large, most people don't have a $750,000 mortgage. So the mortgage deduction remains a deduction. So do charitable deductions.
And I want to talk about the charitable deductions when we come back after we take a break right now.
Okay.
We're just about to take a break. My guest is Tim Bupp, attorney Tim Bupp from CGA Law Firm. This is Legal Lines. We'll be back in a few minutes. Welcome back to Legal Lines. My guest today is attorney Timothy Bupp from CGA Law Firm. We are talking about federal income taxes, specifically the changes that went into effect starting in 2018. And we were talking about itemized deductions before the break, and we were just about to talk about charitable contributions. Now, for years, people who itemized have been able to write off gifts to charities. That they give money to their church, they give money to various charitable organizations. They get to itemize that and get a deduction in their taxes.
The new law was very careful to leave that in place, right? Because in theory, that is so important to our nation. That was always deductible because charities are doing the work of government, which is a good thing. And so we can still make those contributions, and hopefully we will. We can still deduct them or try to deduct them just as we could before, but it's going to be much harder to successfully deduct them because that new exemption amounts $24,000.
So, and you're limited to, we talked about this, you're limited to $10,000 of state and local taxes
Right.
to deduct. You might have home interest, mortgage interest. to deduct.
$5,000 for your mortgage.
So, unless you make charitable contributions that push you over 24,000 of total deductions,
Along with your other deductions,
Right.
you won't get any tax benefit out of it.
Okay.
You'll still feel good about it, but there can be no doubt that the deductibility of charitable contributions was always something that drove charity. And it's unfortunate now that people who would be willing to say, I'll put some money into that charity, I can deduct it, right? Can still say the same thing, but there are going to be very few who can successfully deduct it.
so basically, unless you have a lot of income and can afford large charitable contributions, for the average person, they're not going to be able to deduct their charitable contributions. Somebody, for example, who gives $100 a month to their church, most likely will not get to deduct that anymore.
They'll still get the satisfaction out of it, but it's not going to have an impact on their tax return.
Are charities worried about this?
Very much so, as they should be, right? Nationwide, with the federal estate tax exemption amount increasing, right? The tax impetus to make charitable donations is not nearly as strong as that used to be. The charitable impetus is still there in our great nation, but when you take away that tax impetus, it's going to make a big difference. Now, what does that mean to us? Is there something that we should do about it? Well, I've seen articles where they suggest to people that rather than giving $2,000 in charitable contributions every year, you should give $10,000 this year and then not give any for the next 4 years.
If you can afford doing that.
If you can, but who can afford that, and who wants to do that and then say to your charities for the next 4 years, sorry, I gave in 2018, you're not going to see me for another few years.
Well, I know that even for example, when people donate used clothing to Goodwill or
Sure.
Salvation Army or a charity like that, they typically get a receipt that says this is how much you donated, you can deduct it on your taxes. And people take that and they thank them, but the average person isn't going to be able to do anything with that.
You're going to get the same receipt, you're going to bundle them up, you're going to hand them to your accountant, and he's going to say, sorry, it doesn't make any difference anymore on your taxes. That's unfortunate.
Now, the other thing that I want to talk about is how the new tax law affects people with children.
Kids affect everything, right?
Oh, yes.
The new tax law both has effect on children themselves and on those who have children.
Well, let's
right?
talk about the average family with, let's say, 2 children.
You've got me in the sweet spot because that's
You're
exactly what I have.
You're that average family, that
Right.
average married couple with 2 children.
Think about what
2 minor children.
Yes, 12 and 14, Lucy and Charlie.
Okay.
Think about how the new tax law has affected our family. Before, in addition to the standard deduction that we got, we also received an exemption amount of a little bit more than $4,000 for every individual who was on our tax return.
And that includes you.
Husband, wife, and my 2 children. Between us, we started off with $16,000 in exemptions.
An exemption means it's income you don't have to pay any tax on.
You got that right.
So
right?
even a single person without children, they still got $4,000 taken off as their personal exemption.
You got that right.
And a married couple would have $8,000, and the family of 4, like you just described, would have $16,000 that wouldn't be taxed at all.
Right.
Does that still exist?
which was very beneficial. But that's all going out the window. No exemptions under the new Tax Act. Instead, we have that doubled standard deduction, which sounds great, right? But that's for somebody like me who used to get $16,000 in exemption, and now instead of that I get $12,000 in additional standard deduction. I'm starting at $4,000 in the hole, which was not very attractive. But fortunately, there's a save for that, Tom. And the save is that there's a greatly expanded child credit.
Okay.
It's much different than it used to be
Now
before.
talk about the child credit.
Okay. There's always been that child credit in the tax code. Before it was $1,000 per child, and it's a credit. It's an actual credit, right? So that's $1,000 that comes right off your taxes for
So
every
if I
child.
owe the IRS $4,000 for the year, and I have a child under the old law, I would only owe the IRS $3,000.
That's correct. Or if you owed $1,000 and you had two children, if you were in the right tax bracket, you'd get $1,000 back.
And there are people who actually get money back that they never paid in.
Absolutely, right? And I can understand the rationale for that. For those who have low income and children, we want to do all we can to make sure they can take care of them. Now the child tax credit has been greatly expanded. First of all, it's doubled. It's $2,000 per child now. And the income levels at which you can still qualify for that child tax credit have been greatly expanded. They don't start to phase out until the married couple make, I think it's around $400,000. So more of us qualify for that tax credit than they did before. So with my expanded standard deduction and with a $2,000 tax credit for each one of my children, Lucy and Charlie, I believe that I'm probably going to benefit under the new Tax Act in general. I'm going to find that out when we file our taxes. Unfortunately, Tom, those tax credits for children phase out, and I think your children are a little older than mine.
Oh, yes. Well, mine are on their own now, so I don't have any of that problem. But the people who are really going to face the issue are people who have children over the age of 17 that they're still supporting.
That's correct.
Under the old law, you could claim those children as dependents. I'm typically talking about children in college. You could claim them as a dependent while you were still supporting them while they were going to college. You cannot claim them now.
Now you're correct, but now you're getting into a part of the tax law that I practice less in my practice, and you practice more in. There have been some dramatic changes, from what I understand, in the way that alimony gets taxed. Am I correct?
That's another issue, but if
Yeah.
you want to move to that issue with the alimony, you're interviewing me now.
I am.
Has changed so that for decades, alimony has been structured so that the person paying the alimony gets to deduct it from his income, and the person receiving it gets to pay tax on it. Okay, it's added to the recipient's income. So that still exists right now. It still exists till the end of 2018. But the new tax law says that starting in 2019, it will no longer be tax deductible to the person paying it, and it will no longer be taxable income to the person receiving it. However, there's a grandfather clause in it that basically says that if the agreement for the alimony or the court order for the alimony was entered prior to December 31st
of this
2018,
right,
it will still be deductible to the person paying and taxable to the person receiving. It's only court orders or agreements that are entered into after January 1st, 2019.
I imagine you have a lot of people that are trying to settle their matters right now.
There are a lot of people trying to settle alimony issues right now so that they can get the tax benefit of it.
Now, I'm grilling you on that. You're correct, but it's for a reason. Why do you think that was reversed, Tom?
Oh, it's very simple why it was reversed: to collect more money in taxes.
Exactly.
The government will collect more money in taxes because typically the person paying the alimony makes a lot more money, is in a much higher tax bracket than the person receiving the alimony. So if the person making the alimony is in the 35% tax bracket and the person receiving it is in the 10% tax bracket, then the IRS is out 25%.
That's a very key thing to understand about all of these personal tax issues that we're dealing with. Again, the primary focus of this tax act was to lower the corporate tax act, or tax law, because the idea was that that's going to create more income in general in the economy. But to get it passed, they couldn't lower the tax income too low, and so they had to balance it somehow. And they did that by changing a lot of things in the individual tax laws that look good, but we're not sure how they're going to play out, right? Some of the things they gave and they took away with the same sort of provisions. As I said, my deduction is doubled, but my exemptions are gone.
Okay, and what I want to talk about is, and I don't think we focused enough on it, is the dependencies of children. The tax law for the child tax credit, I should say, $2,000 per child.
Right.
That goes away the year the child turns 17. So if you have a child who turns 17 in December, you cannot claim that child and get the tax credit for that child. Typically, a child of 17 would be in 11th grade, maybe 12th grade, but there's at least 1 or 2 more years of high school that you won't get to claim that child. But when the child goes to college, under the old law, you were able to claim the child as a dependent while you were still supporting the child. Now you are not able to do so. Okay, so although the new law favors young children,
Right.
when children get real expensive, and I've had mine all through college by now, people are not going to be able to claim them at least and get a little tax break for them being dependents.
Everything that you say is correct, and the purpose for those limitations is just as we've discussed. There's only so much tax decrease that they could build into the act, and they did what they could to make the corporate tax deductions work the way they're working right now.
Okay, we only have a couple minutes remaining, and you gave me another topic of miscellaneous deductions that people used to be able to take, but now they can't.
Oh my goodness, there used to be lots of miscellaneous deductions, receipts that we would gather up at this time of the year, expenses, lots of medical deductions. Well, a lot of the medical deductions are still there, especially for larger illnesses. But most of those miscellaneous deductions have been swept away.
Okay.
That category is not even there anymore.
So, I mean, you used to be able to deduct the cost, for example, of even having your taxes prepared.
Absolutely.
Was considered a cost that you could deduct. Keeping your assets in a safe deposit box, you
Yes.
deduct the safe deposit. All those little deductions have gone away.
The $75 you paid for TurboTax right off the bat was deductible,
Okay.
and it's not anymore.
All right, but we have less than a minute left.
Okay.
The sunset.
Oh my
Briefly
gosh.
describe that.
In every Christmas story, there has to be a Grinch, and the Grinch here is clearly the sunset. All of the personal tax advantages that we've been talking about are going to stay in place only until 2025, and then they are going to go away. The corporate tax benefits are going to remain, but unless something changes in 2025, all of our taxes are going to go up again. The brackets are going to go back to where they were before, and we'll be paying tax.
And we end on that happy note. This has been Legal Lines. My guest was attorney Tim Bupp from CGA Law Firm. Thank you for watching. This program is brought to you by the York County Bar Foundation.